Hello, let's start off with this reading called Financial Reporting and Analysis. This topic is very important. Number one reason because its weight is very high. It's around 15 to 18%. That means many questions will be coming in the exam from this topic. So I advise each one of you to study this topic in as much detail as you can. And I feel from my past experiences with my students that this topic is seem to be difficult, but I will try to make sure that each concept is understood. I will go through the examples of each topic and I'll try to make it easier for you. So let's start with financial reporting and analysis. For any analyst, this topic is very useful. Otherwise, you cannot be a proper analyst without this topic. Trust me, apart from other topics, if you miss them out also, you may be able to become an analyst just by knowing this topic also. That's how important this topic is. So the first topic opens up, which is called financial reporting and analysis. This topic has 12 readings and 4 study sessions. A study session in CFA means a section of chapters, whereas reading in CFA means a chapter. So we replace the word chapter by reading. Study session number 1 is about, which is the study session 6. The first study session is about the introduction. We just get the simple introduction of financial reporting and what do we mean by reporting standards. The second study session of financial reporting analysis is very important. It opens up you with different financial statements, such as understanding income statements, understanding balance sheets, understanding cash flow statements, and financial analysis techniques. It makes you learn those techniques. Third study session, I feel, is the most important and also a bit tricky, where students get stuck at times. It opens up to the relevant parts of the financial statement, such as inventories. How do we record those inventories? How do we calculate those inventories? Such as long-lived assets that are also called non-current assets. How do we compute them? How do we record them? Then comes, I feel so that many students feel this topic as difficult, regarding income taxes, that how accounting world record taxes. And non-current liabilities, I also feel this is also be a difficult one, that how do we compute non-current liabilities, how many types of non-current liabilities are there in the balance sheet, how do we compute them, how do we calculate them, how do we record them, how do we report them. And last, which I feel is easy, basic theoretical readings, reporting quality, and financial statement analysis applications. So for me, I would say in financial reporting and analysis topic, the most important study session is 7 and 8, whereas these study sessions are simple and easy to understand. Let's start with the first topic, which is called an introduction. Let's get a brief introduction about financial analysis. I know many of you would be sitting over here, must be scared if you do not know about anything about financial reporting. But trust me, let's try and have this meal slowly and gradually, right? Let's not uh, full up your appetite immediately. Let's take small steps, right? So let's take the first small step of introduction. In the introduction phase, what are we going to learn, sir? Very simple. We'll first open up financial statements. How many types of financial statements are there? As an analyst, how many financial statements are you supposed to analyze? Are you supposed to go through? Next, we'll be understanding the difference between the notes and other discussions in the annual reports. We'll understand the meaning of audit opinions and how many types of auditor opinions are there. We'll understand the meaning of proxy statements and why is it useful for the analyst. And the most important, we'll understand the basic financial statement analysis framework. This is the part we'll be understanding in the introduction lecture. So let's open up. I would advise you to have a book with you or a plain register with you, a pen with you. So if I make you write any notes, you can do so. And if you can have my printout of my notes while watching the video, that's even more perfect. Let's start with it. First question that opens up, the first question that opens up is the difference between financial reporting and the difference between financial analysis. And I want you to think also, think in your brain that what do we mean by the difference between financial reporting and versus financial analysis? What first as a layman, as a normal human being, just first realize the difference of these two words only. Two words, reporting and analysis. Obviously reporting, let's understand the word reporting. Let's forget about financial topic right now and let's understand word reporting. Like let's suppose currently, because in latest half coronavirus had been spread in the entire world. So coming creating an example from there, reporting means, let's suppose you want to know how many cases has been reported in Germany. You'll open up, you'll get the number. That's called reporting. They have reported you how many cases of coronavirus has been identified. That's simply reporting. How many cases have been identified in Pakistan? How many cases have been identified in India? That is simply reporting. They are reporting the results that these are the cases that have been identified. Similarly, let's suppose uh, you are reporting your assets to the tax authorities. Let's suppose you're filing an annual tax. So you're reporting to them how much I earned, how many assets do I have, how many liabilities do I have. You're reporting them which already exists. You're just reporting to that authority. That's what we mean by reporting as a word. Now let's create a difference with that analysis. Now let's suppose you want to analyze. Let's suppose you want to analyze that why so many corona cases have been identified in a specific place. Now you are analyzing the report. You have been reported a specific number of corona cases. Now you are analyzing why they have occurred, how they have occurred. So the questions like why, how, this leads toward analysis. And questions like what, like how many, what, which, like what assets are there, what salaries are there, how many cases are there, reporting. So now create a link between financial of both. So when I say financial reporting, let's suppose there's a company. I want to know how many assets do they have. I want to know what liabilities do they have. I want to know how much cash do they have, how much equity do they carry. If I want to know all the how much profits do they make, obviously I will not be knocking the door of the company and calling them and asking them all. I would want the company to report that to me, because I'm the investor. I want to invest and I want to know the company's financial position, the company's financial performance. Hence, I want the company to report that to me. So if the company is using or is reporting these things in a statement or through different statements, we call that financial reporting. Obviously, we call that financial reporting. And obviously, there must be many various rules according to which these statements must be prepared. There must be various rules according to which reporting must be done. So reporting is totally a different subject which we will always obviously study, that how do we report things, how do we compute things, how do we record things. So we will be studying about that. So I can say in reporting, record, how do we record, like in which account do we record, in which account we create, we take a credit side, in which account we take a debit side, or in which account we need to make the entry, out of which account we need to remove the entry. This is called recording. Number two, we need to also understand where to report, which statement to report this. Like profit, do I show that profit in bank statement? Do I show that profit in income statement? Where do I need to report that? Where do I need to report profits? Right? So in financial reporting, two things come up: record and report. So these are the two things that comes up in the financial statements. Whereas in financial analysis, we are using these questions to analyze these statements, that whether these statements show a good indication about the company, whether we have seen growth in the profits, whether we have seen growth in the cash flows. We want to analyze that how come, or through what means, the company was able to create this much assets. Is it good? Is it bad? These liabilities, is it good? Is it bad? So all these things will be seen in analysis. So I hope you get a difference between financial reporting and financial analysis. Reporting is a way of using rules and regulations to report something, whereas analysis is a very strong skill that you will learn while doing CFA. It's a skill, it's an analytical skills, evaluation skill that you will need to apply while doing financial analysis. So just, summarizing this concept. So if a company informs you their profits are 500,000, we call this reporting. The company is reporting their profits. As an analyst, what you need to do is you need to analyze that whether how what company was able to reach towards these profits. Is this performance good or not? What were the factors that contributed towards this profit? Are those factors sustainable or not? Do you see that company will how do you see company will project in the future? All these questions are a part of analysis. So remember that in CFA you need to work hard to improve your analytical skills. That's what you're going to be paid for. You're not being going to be paid for just going and reporting some stuff. No, you are being paid for analyzing the company. All right. I hope you understand the difference between these two. Let's move forward. Another interesting question pops up, and that question is, sir, why do we need financial analysis? Why do we need this skill? I mean, why need for financial analysis? So in other words, we can rephrase this question also, that where would this financial analysis be applied, on what situation, in what decision making? So one by one, I'm going to understand them. Let's suppose you are an investor and you want to invest in company's stock. So obviously for that matter, you would need to analyze their statements, whether it's a good investment or not, whether will it be fruitful for the future or not, will it be profitable for the future or not. So you need to analyze their reports. Number two, let's suppose you are a company and you are merging with another company or acquiring another company B. So obviously, again, you will have to analyze company B, whether will it be a good thing, good deal for you to merge with them, a good deal for you to acquire them, whether will it be profitable or not. So obviously, you will be going through financial analysis and so many things like evaluating a subsidiary or operating division of a parent company, deciding whether to make a venture capital or private equity investment. Venture capital means whether to invest in a newborn company, a new idea, or invest in established private equity or private firms. Determine the credit worthiness of a company. Let's suppose you're a bank and a company has come to you for loans. Now, obviously, bank will have to do a financial analysis that whether the company is worthy enough that we give them that much loan or not. Extend credit to customer. Let's suppose a company is your customer. Obviously then you will have to analyze that company, whether we need to, shall I extend credit to that company or not. I will need to see their financial reports. Next, examine compliance with debt covenants. Assigning a debt rating to a company or a bond issue. There are many big companies which assign ratings to different companies on their credit worthiness, such as Fitch, Standard and Poor's, Moody's. They assign credit ratings. In order to assign credit ratings on their credit worthiness, these companies have to do financial analysis, a good one, an in-depth financial analysis. Next, valuing a security or for investment recommendation. Now, let's suppose someone has come to you and he is asking which would be a good stock to invest in. He's asking for your advice. You will not be sitting down and advise from, why not even thinking anything, by not even analyzing, and you just on your judgmental analysis you advise anything. You would not do, obviously. That means you are ready to make your customer at a loss. You would not do that. You will obviously do a better due diligence and a good analysis, financial analysis, and then only you will advise your customer whether to invest or not. And lastly, for forecasting future net income and cash flow. So if you want to forecast how the company will grow in the future, how their cash flows will grow in the future, then obviously you will have to do financial analysis. Now you must have got the importance, that what is the importance of financial analysis. This is the importance. And you can also see your job roles also, that how different job roles you can have in financial advisory or in merger and acquisitions or in investments or in compliance. So you can also see different job roles also. So this is the reason we do financial analysis. Hope this also makes sense. Let's move on. Now next, we understand financial statements. How many financial statements the company reports? Let's understand that how many financial statements the company reports. Number one it reports is called the income statement. Number one that it reports is called the income statement. So how many items are there in the income statement, or what items are there? Basically, companies will be showing how much revenue company has earned by their normal course of business, how much revenue they have earned. And in order to earn that revenue, how many expenses they incurred, right? And along with these operations, what gains and losses they had to go through. All these three things come into income statement. For example, let's take an example of, let's suppose, Toyota. So let's take an example of Toyota, one of the best automobile companies. So Toyota, normal course of business, major course of business, automotive. Automotive means it produces vehicles and sells it. So this is the normal course of business. So revenue would be something, how much money are they getting through selling their cars? How much are they benefits? How much benefits are they getting by selling their cars? That's revenue. Obviously, in order to sell those cars, they would be making significant costs, like producing that car, cost of sales, expenses, hiring marketing professionals, hiring the administrative staff, giving rents on big factories, offices. These are all expenses to run their operation, to earn that revenue. That will come into expenses. Along with that, obviously, they may at times face some losses in their assets. They may at times face gains in their assets, such as, for example, the factory may, like in Japan, at times the factory may be devastated by the earthquakes. That's a complete loss of a factory. That's a loss for them. And at times, due to market going really up, the values of their assets may go up. That's a gain for them. So that we also reflect in the income statement. For gains and losses, there is also another part which we will understand later on, which is called OCI, other comprehensive income, OCI. We also reflect some of the gains and losses in this section also. For now, just remember this, there is also a part called OCI, which we will understand later on. Number two balance sheet is called number two financial statement is called the balance sheet. Like let's suppose now Toyota wants to report how many assets it has. Obviously, in order to generate the revenue of their normal course of business, Toyota needs assets. Toyota needs finance. Yes or no? Toyota needs assets. Toyota needs factories. Toyota needs equipments. Toyota needs plants. Yes or no? Toyota need raw materials. Toyota need inventories to create that vehicles. So those are assets that Toyota needs. Now, where do we reflect those assets? We reflect them in the balance sheet. In order to buy those assets, Toyota need to finance either through their owners, that is equity, or finance either through debt, raising debt. So they also need to have equity and debt. Where do they need to report that? In the balance sheet. So balance sheet, in the balance sheet, what things are reported? Assets, liabilities, equity. These three things are reported in assets and in the balance sheet. So if you want to see how many assets a company have, how many liabilities the company have, you will look into their balance sheet. I will show you the glimpse of it later on. Third statement is called the cash flow statement. It's called the, now you, if you must be concerned also that how much cash flows Toyota generates, how much cash outflows Toyota makes, in what activities how much cash outflow is being generated, is being going out, and in what activities how much the Toyota business is making inflows. So if you want to know that how much cash is going out and cash is coming in, you will look into cash flow statement. Cash flow statement is divided into three business activities. So the business have primarily three activities. The business have primarily how many activities? Three activities. Number one, the most major activity is their operation. Like let's suppose Toyota. Why Toyota was established? Obviously for running an operation, for selling, for producing and selling cars. That's the reason Toyota was established. So that's the operational activity, the activity in which they manufacture cars and sell cars. That's called the operating activities. Obviously, either the cash will inflow in that activity, usually by selling cars cash is inflow, or may go out of that, the cash may go out of that because of that activity. So one is operations. For operations to start their operation, obviously Toyota needs to make investments. Without investment, it cannot succeed in that operation. It needs factories, it needs equipment, it needs plants. So second is the investing activities. They need to make sure they are running with the investing activities to complement their operational activities. In order to invest, they need finance. That's financing activities, whether to raise debt, whether to raise stock, whether to repay debt. This is financing activity. So if you want to inquire or you want to look how much cash has been flown into or flown out of these activities, you will look into cash flow statements. So if someone wants to see the liquidity of the company, the best statement for him to look into is the cash flow statement. Next statement is called the statement of changes in equity. Statement of changes in equity. Like let's suppose you are the owner, you are a shareholder of Toyota Corporation. You have a certain portion of shares in Toyota Corporation, and you are concerned how the book value of my equity has changed. Like let's suppose from at the start of the year, your equity was mounting to be 50,000. You want to know how my equity changed by the end of the year. Let's suppose by the end of the year, the book value of equity is 70,000. So you are concerned, why is there a change of 20,000? So you will see the statement of changes in equity. In that statement, it will show you what were the reasons behind the fluctuation in your equity amounts. So we have taken a very basic glimpse of different statements. We haven't gone into detail, neither I want you to go into detail right now, because this is a very introductory topic, right? If I'm teaching just the basics, stick to that. Do not cross those boundaries. Stick to the boundaries that I am keeping with my lecture. Okay. So we are done with the statements, number of statements. Let's move on. So this is a glimpse of the income statement. Income statement. So here comes the format. These are the revenues. You can see the net sales. It is reflecting you net sales. So what do we mean by net sales? Net sales is the sales amount minus sales returns, minus any sales returns. We get net sales. So here are the net sales. We also call this net revenues. We also call this net revenues. Expenses and losses are minused. Number one that is minus is called the cost of goods sold. Then all the other expenses are minus: selling expenses, general administration, loss on sale of land. You see, now he's making a loss on asset, so he is reporting that. Interest expense and all those income tax expenses, you get the net income. We also call this net profit. The format that we are looking right now is called the single step format. It's called the single step format, which is simple, that you take sales and then minus all the costs from it and you get a net income. There's also another famous format which is called multi-step format, which is more popular. This is, first we compute net sales. From that, first we deduct cost of sales, and then we first report gross profit, and then we minus all the other expenses. That format is called the multi-step. Now always remember, when do we need to, or what does the income statement show? It shows the financial performance of a company for the year. Let's suppose how Toyota performed in 2012. I want to know how Toyota performed in 2021, or pardon me, 2020. So if I want to know how Toyota financially performed in 2020, I will look into their income statement. I will look into their income statement. Now let's take a glimpse of balance sheets. So this is the balance sheet. So because this, I've divided into two sections. Otherwise, the balance sheet is straightforward aligned. So this part comes underneath this part. Because I did not have space, so I have shown side by side. Otherwise, this comes down the bottom of total assets. You can see in balance sheet, it shows assets. It shows, one side is showing the total assets, all the assets. So here's the total assets. And the other side is showing you the liabilities and equity. So this side shows you liabilities and equity. The one side is showing you assets. They're not side by side. They go straight down. So the first portion comes as the asset, and down underneath that comes the portion of liabilities and stock equity. So if you want to, or if a question pops up, what does this statement shows? This statement shows you the financial position of the company. So if you want to inspect, or if you want to understand the financial position of the company, you will look into financial, if you will, pardon me, you will look into balance sheet. This balance sheet is also called statement of financial position. In modern language, this is also called statement of financial position. Remember that balance sheet is made at a specific point of time. It is not made for the year. Like let's suppose Toyota 2020. So the balance sheet would be made as at by the end of 2020. How many assets does Toyota holds? How many liabilities does Toyota have? How much equity does Toyota have? So it is made at a specific point of time. Whereas income statement was made for the year. It was made at how much Toyota made profits for this specific year only. It was not made that by now how much Toyota has made profit from the start of their business. Not made for that purpose. So income statement is made for the year, whereas balance sheet is made for a specific point of time. Hope this is also clear. So to further understand the concept of balance sheet, I want you to understand the very basic concept of something called accounting equation. This will be very useful for those who are not from financial backgrounds or haven't studied much financial accounting. There's an accounting equation that needs to be followed and it will always remain in balance. What is that? Like, let's suppose you start a company. In order to start a company, a basic equation is that if company wants to start off its business, obviously the company needs to buy assets. So the company will buy assets. So it can start its functions, it can start its operations also. So the fundamental, the requirement is to buy assets. You will obviously, without assets no business can start off. While keeping cash in the bank, no business can start off. You need to translate that into assets. In order to buy those assets, either you will be using your own money, which is called equity, or you will be owing some money or borrowing some money, which is called liability. So your assets amount will always be equals to the sum of equity plus liability. So we get a basic accounting equation, which is assets is equals to equities, equity plus liabilities. So this is the basic accounting equation one has to always follow. And in accountancy, if this side increases, we say that transaction is being debited. And if this side increases, we say that transaction is being credited. And vice versa, if this side decreases, it is called credited. And if this side decreases, this is called debited. And always remember, the equation will always stay in balance. Both the sides of equation will always stay in balance. They will always be in balance. Remember that, right? They will always be in balance. So if, for example, if I again draw an equation, equity plus liability, if assets increases, simultaneously two or three things can happen. Either equity will increase, the equation will get in balance. Either liability will increase, the equation will get in balance. Or either from the other side, asset might be decreasing also. Like, let's suppose you sold one asset and you got cash. So cash is also an asset that we'll study uh, as we move on further. So one asset might increase, the other asset might decrease. I hope you get that point. Let's also get an idea of basic assets and liabilities. For the ones who are new to this, assets are said to be such as property, plant and equipment, cash, receivables, inventory. These are all assets. Equity is said to be such as ordinary capital, ordinary share capital. This is called equity. So ordinary share capital will come into equity. Adjust a glitch. Wait a second. Yep. So such as ordinary share capital, equity is a ordinary share capital is a part of equity, especially for companies. And company issue their equity, they issue in terms of shares. Ordinary share capital. In liabilities, we have debt. One of the biggest liabilities, we have payables such as trade payables and different note payables, trade payables, bond payables, and many other liabilities are there. We'll understand that as we move on further. So remember that this equation needs to be in balance always. Let's move on further and understand one more thing now. Now, the another basic element of this reading is the difference between financial statement notes and management discussion and analysis. As being an analyst, you should be knowing this also. Let's understand this. See, obviously, a company reports many statements such as income statement. We have studied income statement shows revenue, cost of sales, less expenses. There is also called balance sheet. There is something also called cash flow statement. So these are the statements that the company prepare and report them to its owners or shareholders or its investors. Obviously, all the details we cannot take into consideration in a single statement. For example, let's suppose non-current non assets. For example, assets balance sheet is showing how many equipments does the company have by the year end. Now obviously that much detail is at times is not enough for an analyst. Like analysts may be also interested in knowing that how many equipment was purchased this year and sold this year. He may be interested in knowing that. He may be interested in knowing by what amount the equipments depreciated their value this year, and so on, and so many other things, right? Obviously you cannot consider all those information in single statement. Otherwise the statement will become in so much detail that one may not be able even be able to understand that statement. So the details about the items that have been shown in the statement, the details about them are written down underneath that statement by the name of notes, footnotes of the statement, or disclosure notes. Footnotes or disclosure notes. So notes are provided with details that how many equipment bought. So there would be a note for equipment, how many equipment bought, how many sold, how much depreciated. There will be a note for different assets, all the details of different assets, their procedures, methods, policies. So all the details would be you will be finding out in the notes to the financial statement. Each financial statement have footnotes underneath them. So if you're looking for further details, you can go through their notes. So the complete income statement would be this part plus the disclosure notes. So each statement will have their own disclosure notes. Now remember that where does the company reports these financial statement? Company reports them in a single report which is called annual report. Company issues its annual report, and in that annual report there is a part which is called financial statements, and through their annual report you can go through their financial statement. For example, if you want to see the financial statements of Toyota Corporation, you can go to their website, write the financials of Toyota, and you will find their reports, annual reports of Toyota. You click them and you'll get financial reports of Toyota. So in annual report there is a part of financial statements. Sir, is there any other part in the annual report? Yes, there is also a part of management discussion and analysis. In this case, management is discussing, is analyzing, and it is giving their own perception. It is giving their own that what they feel about the company, how they feel the company has performed. So in the MDA, that is management discussion and analysis, the company is telling you things by their perception, what they feel about the company, how the company has performed, how the company has grown from the company's point of view. Remember that, from the company's point of view, from the management's point of view. We can say better word is from the management's point of view. So if you want to know the management thoughts, if you want to know what management feels, why certain decisions management have taken, why, let's suppose, management launched a new car model of Toyota, new product, why did they launch that product, why did they discontinue one product, you cannot find those details in the financial statements or in the footnotes. You will have to look that information in the management discussion and analysis. So let's go through a brief of it. So just going through the brief out, there are two things: financial statement notes and management discussion and analysis. You being as an analyst, you must be sure that what difference is in between them and what things I can look up to in the notes and in the financial discussion and analysis. Number 1 point for footnotes. These includes disclosure that provide further details about the information summarized in the financial statement, the point that I raised. Number two, it allows users to improve their assessment about amount, timing, uncertainty of the estimates. It helps you to understand more about the, how many purchases you made for equipment. You can make an assessment about amount for, you can also make an assessment about projections. Three, provide information about accounting methods, assumptions, and estimates used by the management, such as depreciation method, such as inventory LIFO, FIFO, FCO methods, such as taxation methods, and so there are many other policies and methods. For now, just what I gave you examples, remember that, otherwise we'll be studying each and everything as we move on in the financial reporting. Four, provides additional information on items such as business acquisition. If you're acquiring some business, it will give you details: how much cost will it cost, how much money you will be making from it, what synergies you'll be getting, if there are any legal actions you have taken. So you will be writing that in the footnote, that what consequences you can face if you lose that case. Employee benefit plan: if you are paying pensions to your employees, you will write in the notes that how much pensions you are supposed to pay to your employees, all the details about your pension plan. So these are the footnotes. Whereas in the management discussion and analysis, that provides assessment of financial performance and condition from management perspective. So if you want to know things from management perspective, if you want to know the assessment from management perspective, you will look into management discussion and analysis. Number two, results from operation, trends, capital resources, liquidity, and general business overview. You will find that in the management discussion and analysis. Along with that, as per USA Security Exchange Commission, certain things are to be shown in the management discussion analysis, meaning that this is being obligatory for companies to must show this in their management discussion and analysis. That are four things. Number one, effects of inflation and changing prices if material, they have to show. Impact of off balance sheet obligation and contractual obligations such as purchase commitments. So let's suppose if a company has made certain purchase commitments, that is a contractual obligation. Company will have to purchase that much amount later on. So they have to disclose this in management discussion analysis, that many commitments we have already made for purchasing from different companies. Third, accounting policies that require significant judgment by management. If there is any accounting policies used by companies that was 80% at the basis of that accounting policy or the management discretion, they have to show that discussion. And forward-looking expenditures and divestitures. So forward-looking expenditures means the projection of what expenditures you will be doing in the future. That must be reflected in the management discussion analysis. And divestitures, what portion of company are you thinking about to sell or scrap? That's the divestiture. You're separating that from your company. These items must be a part of management discussion and analysis as per US Security Exchange Commission. This also helps identify events and uncertainties that affect firms' liquidity, capital resources, and results from operations. So MDA will help you out in this. So, but remember this, that obviously we haven't studied yet about this concept, but for now, just remember this, that financial statements are always audited. We'll understand what is audited means. But management discussion and analysis is non-audited. Management discussion and analysis is non-audited. So it is always safe to believe in audited things rather than believing in non-audited things. Very simple example, audit means check and balance, and non-audit means no check and balance. We'll understand the word audit as we move on to the next slide. I hope you're getting an impact. What have we done up till now? We understood the meaning of reporting. We understood the difference between financial analysis and reporting. We understood regarding the different financial statements. We understood regarding the accounting equation in the balance sheet. We understood about the financial statement notes and management discussion and analysis. Hope you're getting an idea. Hope you're getting the feel of financial reporting and analysis.